Hello, welcome to the channel. Today we are going to analyze two stocks, one with a 5% current yield with a 2% dividend compound annual growth rate, the other with a 1% current yield and a 6% dividend compound annual growth rate. So basically what that means is this stock A here, is paying a higher yield up front. So initially you would get more cash flow from the investment, whereas stock B is growing the dividend at a faster pace, but it's not paying as much initially. So typically as you get closer to the age when you want to use your dividends, this may mean retirement, this may mean financial independence. Whenever this is for you, you may want to use dividends now to increase your lifestyle or pay down bills, not have to work as much, whatever your reasons are. You may want to go with a stock like stock A that's going to pay you more initially. However, if you're someone who's planning on working for a long period of time, let's say you're in your 20s, maybe you're in your 30s, you love your job, you want to work for a very long period of time, you really don't need the money. You may want to go with a stock similar to stock B that has a higher dividend compound annual growth rate. So over long periods of time, this will typically pay more at some point. So we're going to analyze and look at those stocks and see what the dividend would be over relatively long periods of time. We're going to go from year 1 all the way to year 40. We're going to only do every year to year 10, the first decade, and then we'll do every 5 year. I'll just show the results. But I want to really illustrate how simple this is to calculate. And I just want to emphasize that you do not have to have a PhD here to do this kind of math. This is stuff that anyone can do. I'm going to use the calculator off Google search. You do not have to be an expert. You are smarter than you think, and you can do this math. So let's go ahead and dive right in. So what do we have here? Stock A. This is paying a 5% current yield with a 2% dividend compound annual growth rate. So for this example, we're going to say both companies are $100 per share, just to keep everything simple, use nice round numbers. Obviously, you buy both, right? Let's say you buy one of each. Okay, you buy stock A, you buy stock B, you spend $200. Hooray. Congratulations, you're in the game. So after 1 year, you would have received $5 from stock A, and you would only have received $1 from stock B. Okay, but now let's see what would happen after 1 year, right down here. So as you can see, in the second year, you would receive $5.10 from stock A, right? So how do we get that number? How do we know that's happening? It's very simple. Take the current yield times, let me go to the calculator. So $100 per share, right? So it's paying you $5, right? Very simple math. First year, $5. There it is. Now, how do I know it's going to pay the next year? So we take the $5 times 1.02. There's your 2% growth. So times 0.1.02. There's your 2% growth for that year. Boom. 5.1, $5.10. Okay. So after 1 year, now you got your 2% increase. Now you're at $5.10 per share per year moving forward. Okay, but they do it again, all right? Every year they do it. So now after another year of holding the stock, you've already been paid out $10.10. Now times 1.02 again, because we're going off this number. That's why it's compound, right? So it's not off the $5 anymore. Now it's off the $5.10. So once again, all we're going to do is spam this formula here, whatever we're using, times 1.02, 2% increase. Boom. Here it is, $5.20. Okay, we're going to round that just to the cents. We're going to forget about that too. But there you go, $5.20. Let's put that in. There we go. And now let's do it again. What will we get after the third year now? Okay, times 1.02. $5.30. Okay, right there. All right, and then the fourth year times 1.02. Okay, $5.41. All right, so $5.41. So the rest of the math I've already done. I did this very quickly just by continuing to press times 1.02 times 1.02. I did that 4 times to get the total math here. But as you can see, you got $5 initially, and after 10 years, you're up to $6.09. Okay, so that's how this one is growing. Now let's look at the other one, and then we can kind of compare and contrast them. This is your 6% grow, but it's only starting at 1%, so it's a very low starting yield. Okay, let's have a look at that. Here it is, stock B. I'm actually going to pull that up so we can put it a little closer to A here. Okay. So look, you're still very far behind on the same $100 you put in, because now stock B here, after a year, it's paying you $1.06, then $1.12, $1.19, $1.26, $1.34, $1.42. After 7 years, you're at $1.50. So you can see all the way to 10 years, $1.80. Now that's also very simple to calculate. So let's start with this. It's $1, right? So you got your dollar. Now we just do times 1.06. Okay, that's our 6% growth rate. So after a year, they raise it up 6%. And here we go. There's your $1.06 times 1.06. And you could just keep doing that until infinity. There's 3, 4. This is all I did here, guys. Times 5. So $1, we'll call that 34 after 5 years. And lo and behold, there it is, $1.34. Okay, so very simple here, guys. Something you should get familiar with. You should try complicated, double check your work, obviously, but very simple way of, kind of putting things apples to apples, seeing where the income would go moving forward. But now I have some further out projections here. I wanted to really illustrate this one. So this is after 15 years, 20, 25, 30, 35, and 40. You have stock A, just put the A here, and stock B. So right off the bat, the first thing I saw here was that from year 15 to 40, stock A does not even double. Okay, it does not even double, right? Whereas stock B from year 15 to 40 more than quadruples. All right, so this is really starting to pick up steam. It's boom, boom, boom. Now it's jumping. But still, nonetheless, at the end of 40 years, there's still more income coming from stock A, which was our high initial yielder with the slower growth rate, which was interesting to me. I was a little bit surprised by that, actually. So utilize this information, take from it what you will, and you can make your own investment decisions based on that. Obviously, this is not financial advice or tax advice. I'm not a licensed professional advisor or tax consultant in any way, shape, or form. This is just simple math that anyone can do on their computer. And I had fun analyzing this. And I think I'm going to do a few other ones, manipulate the numbers up here a little bit, potentially think about some companies, actual companies, right, instead of stock A and B, and put them head to head against each other. Obviously, you can't predict what the exact compound annual growth rate will be moving forward, but you can do your best and just kind of figure out what you think it'll be. But I just want to put this out real quick, guys. Thanks for watching. Some other great channels are the Money Guy, PPC Ian, and the Dave Ramsey. As always, do your own research, and thank you. Please like and subscribe. Have a good one.